Bismillahirrahmanirrahim. This is the second video on proved property cost disposition under successful efforts method. In this video, we will continue talking about cost disposition through amortization. In the previous video, we explained how to calculate DD&A when oil and gas reserves are produced jointly and on a field-wide basis, and how to calculate estimated future dismantlement, site restoration, abandonment cost, and salvage values. In this video, we will talk about exclusion of cost or reserves. We will explain how to calculate depreciation of support equipment and facilities. We will talk about cost disposition non-working interest that will include DD&A on overriding interest, multiple non-working interest, DD&A on production payment interest, and finally revision of DD&A rates. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We also hope that this video helps fresh graduates who have joined the oil and gas companies and want to refresh their learning on exclusion of costs or reserves, depreciation of support equipment and facilities, cost disposition, non-working interest that includes DD&A on overriding interest, multiple non-working interest, DD&A on production payment interest, and revision of DD&A rates. So let us start with discussing exclusion of costs or reserves. The capitalized cost of all wells and related equipment and facilities in a cost center, that is property, field or reservoir, is to be amortized over the proved developed reserves recoverable from that cost center. However, problem arises in situations where significant cost of a development project have been incurred, but a portion of the proved reserves are still undeveloped. For example, assume that an offshore platform capable of producing 5 million barrels of oil and gas is constructed at a cost of 5 million. However, at the time the platform goes into service, only 2 of the anticipated 10 wells, each capable of producing 1/10 of the proved reserves, have been drilled. Recall that cost of wells and related equipment and facilities are to be amortized over proved developed reserves. So 5 million cost has to be capitalized. But only 20% of this cost will be amortized, as 2/10 of the reserves are proved developed reserves, while 80%, that is 8 of the 10 of the proved reserves, are proved undeveloped reserves. If significant development expenditure has been made, but a portion of the related proved reserves are not yet developed, then that portion of the development cost should be excluded in determining the DD&A rates until additional wells are drilled and all of the related reserves are proved developed reserves. Proof developed reserves are defined to be reserves that are expected to be recovering from existing wells with existing equipment and operating methods. This means that if the proved reserves are developed, then related development costs have already been incurred. Later on, the company can Later on, the company can incur an additional cost on improved recovery system, and such cost must be excluded in determining the DD&A rate. Let us look into an illustration in this regard. Lucky Oil Company has constructed an offshore drilling platform costing 18 million. At the end of 2007, only 2 wells have been drilled at a cost of 3 million, with 16 more wells to be drilled. So the total number of wells will be 18, 16 plus 2 in the future. Proved developed reserves at year end were 3 million barrels and 300,000 barrels were produced during the year. So you can see that a portion of the drilling platform must be excluded in computing the DD&A because of the 18 total wells to be drilled, only 2 have been completed. Therefore, 16 will be completed in the future. In such a case, 16 upon 18 of the 18 million platform cost should be excluded, and let us see how we calculate the DD&A expense. So we have the platform costing 18 million, and of these only 2 have been drilled so far, so we will take 2 upon 18 plus 3 million divided by 3 million plus the production of 300,000 barrels times 300,000. So this will be equal to 454,545. Now in this example, the amount of development cost to be amortized is determined based on the ratio of wells already drilled over total wells, both drilled and yet to be drilled. Let us solve one more similar exercise. And during 2019, O'Neill Oil Corporation constructed an offshore production platform at a cost of 25 million. In total, 16 wells are planned. As of 31st December 2019, only 2 out of the 16 wells had been drilled. So we have to calculate the DD&A, and first of all we will calculate the DD&A for leasehold. And for this we have the leasehold cost of 300,000 divided by the proved reserves, and they are at the end of the year, so we are going to add to this the production cost 1,800,000 plus production of 100,000 barrels times 100,000 barrels, and this will be equal to 15,789. Next we are going to calculate DD&A for the wells. Now in this case we have the drilling cost of 2,200,000 plus we have the production platform at a cost of 25 million. So we have 25 million and only 2 out of 16. So we will take only 2 out, divided 2 over 16, divided by the proved developed reserves, that is at the end of the year, so 900,000, and to this we are going to add the production cost of 100,000 times the production of 100,000 barrels. So this will be equal to 5,325 532,500. Now, yet another method include drilling cost incurred over total expected drilling cost or proved developed reserves over total proved reserves. So let us solve an illustration in which proved developed reserves will be produced only after significant additional development costs are incurred. Now, Lucky Oil Company has an offshore lease that has proved developed reserves of 50 million barrels at the beginning of the year. This is interesting. It is at the beginning of the year. Of those 50 million barrels, 10 million are associated with significant development cost to be incurred in the future, and that's why we are not going to include this cost. Total capitalized drilling and equipment cost, that is wells and related equipment and facilities at the end of the year, are 3 million. Production is for 250,000 barrels. So proved developed reserves associated with the future development cost is not going to be included, or rather it has to be excluded in calculating DD and A. So DD and A expense is equal to 3 million divided by 50 million minus 10 million, because this is associated with the future cost, so that will be 40 million times the production of 250,000. You can note that because the reserves are estimated at the beginning of the year, so that's why production is not added in the denominator or the DD and A calculations, and this will be equal to 18,750. Under no circumstances should future development cost be included in computing DD and A expense under successful effort costing. So let us solve one more exercise. And Atmos Energy just completed December 28 to 2020 the successful testing of a tertiary recovery pilot project, and as a result has determined that 900,000 barrels of oil should be classified as proved developed reserves. However, 200,000 of the 900,000 barrels will be produced only after significant future development, so this will be excluded. Calculate DD&A for Atmos wells and equipment, assuming net capitalized drilling and equipment cost is 1,850,000 and production is 40,000 barrels. So we have the cost to be capitalized as 1,850,000 divided by 900 minus 200. This is to be excluded, that will make 700,000, and because this is at the end of the year, so we are going to add the production of 40,000 times 40,000, so this will be equal to 100,000. I will repeat that under no circumstances should future development cost be included in computing DD and A expense under successful efforts accounting. Next, let us talk about depreciation of support equipment and facilities. Now, two things are analyzed when support equipment and facilities are acquired. Number one, did the equipment or facilities serve only one cost center, or which activity or activities, that is property acquisition, exploration, drilling, production, etc., the equipment or facility supported. Now, support equipment and facilities cost should be capitalized to the cost center they serve and depreciated using the unit of production method over the proved developed reserves of the cost center. If the support equipment and facilities cannot be identified with a single field or a cost center, then unit of production method is not appropriate, and in such a situation straight line or unit of output method or sum of the years digit method should be used. Similar issues arise when support equipment and facilities used for more than one activity. For example, an equipment is used for during property acquisition, exploration, development, and also production, also during production or multiple cost centers. For example, a warehouse might be store equipment used in both drilling and production activities for all of the properties, or a truck might be used to travel between the drilling locations and the production locations. A field office building could be used to support all types of activities for numerous properties. In each of these cases, the depreciation should be allocated to activities served based on usage and either capitalized or expensed depending on the activity. For example, if a truck is serving multiple field or cost centers, then first it should be depreciated using straight line or unit of output method. Next, the depreciation is then allocated to the activities being served. It may be production or drilling or development, etc. So just keep in mind that the portion allocated to production activities is written off as operating expense, while the portion allocated to non-drilling development cost is capitalized to lease and well equipment for each of the cost centers the truck is serving. The cost is then depreciated along with the other capitalized cost for the cost center using the unit of production method. The portion allocated to drilling is capitalized to wells in progress for the wells being drilled in the various cost centers being served. If the wells to which the costs were allocated were dry exploratory wells, then the wells in progress accounts would subsequently be cleared to dry hole expense. If the wells to which the cost was allocated were development wells or service wells or successful exploratory wells, then the wells in progress accounts would subsequently be cleared to lease and well equipment. Cost of support equipment and facilities serving multiple activities within a single cost center are capitalized directly to the cost center and amortized with wells and related equipment and facilities using unit of production over the life of the cost center. Now, theoretically, depreciation of support equipment and facilities is allocated to exploration, development, or production, but in practice, the depreciation on the support equipment and facilities is not separated and allocated between multiple activities. Rather, it is expensed as DD&A expense. Now, building and equipment that cannot be related to specific activities like the home office building should be depreciated using straight line method or unit of output method, etc. In such a case, depreciation become part of the general overhead. So let us look into an illustration. Now, Assume Lucky owns the following assets that are used to support operation in various cost centers during the year 2005. So they have two assets, a warehouse and they have an automobile purchased on 1st of January for 100,000 with an expected life of 20 years. Approximately 80% of the equipment stored at the warehouse is ultimately used in production operations and 20% in drilling operations. During the current year, 10 production operations were served and 5 wells were drilled. Ignore the salvage value. So the depreciation in this case for the year will be the cost, that is 100,000, divided by the number of years, that is 20. So that is equal to 5,000 per year. Now 5,000 of this depreciation would be allocated to production operations and drilling operations. You can see for production approximately 80% and 20% for drilling. So for production it is 5,000 times 80%, that is equal to 4,000, and for drilling it is going to be 5,000 times 0.2, that is equal to 1,000. So the 4,000 is related to production operations and it will be allocated to the specific properties served and recorded as operating expense. While the 1,000 that is related to the drilling operations will be allocated to the specific wells being drilled. The 1,000 will be capitalized to wells in progress and cleared according to whether the well were exploratory type well or development type well and whether they were successful or dry. So this is all about the warehouse. Let us talk about the automobile. They have purchased for 30,000. It is estimated that the automobile will be driven a total of 100,000 miles during its useful life. Accumulated depreciation is 5,000. This year the automobile was driven 5,000 miles related to property acquisition, and 50% of the property under consideration were leased. 10,000 miles related to production activities and 5,000 miles related to the drilling of development wells. Now, so the depreciation in this case will be 30,000 divided by 100,000. So the depreciation is 30,000 divided by 100,000 miles, that is equal to 0.3 per mile. Now for property acquisition, 5,000 miles. Property acquisition 5,000 miles at the rate of 0.3, that is 1,500. Now the 1,500 will be allocated to the properties that are considered and then capitalized if the properties were leased, or charged to expense if the properties were not leased. And then we have the production activities. This was for the property acquisition, and now we have the production activities. It is 5,000 miles again, 10,000 miles to related to production activities. So 10,000 into 0.3, that is equal to 3,000. Now this 3,000 will be allocated to the producing properties because this is for production activities, and charged to operating expenses. Then 5,000 miles related to the drilling and development wells. So for the drilling we have 5,000 miles at the rate of 0.3, that is 1,500. Now the 1,500 will be allocated to the wells that are drilled and then capitalized. Now since the wells are development wells. Let us solve one more exercise on depreciation of support equipment and facilities. Now, Bingo Oil Corporation recently acquired a truck costing 60,000 with an estimated life of 5 years. Ignore salvage value. The foreman drives the truck to oversee operations on 7 leases, all in the same general geographical area. The foreman keeps a log of his mileage in order to determine how the truck is utilized. Analysis of the log indicate that one-third of the mileage driven was related to travel to drilling operations, one-third related to travel to G&G exploration, one-third related to travel to production location. Bingo uses the successful efforts method of accounting. Give an entry any entries necessary to record depreciation on the truck for the first year that it was in service, assuming the 7 leases were located on different reservoirs. Now, since the truck is used on multiple cost centers, so it will be depreciated using a method other than the unit of production. It may be straight line. So we have the total cost of 60,000 divided by the life, that is 5 years. So that is equal to 12,000 per year, and the truck will be depreciated one-third to the well in progress. So well in progress intangible drilling cost, so one-third of 12,000 will be debit, and this will be debit by 4,000. And then we have the G&G expenses. So G&G expenses, again one-third of 12,000 is 4,000, and we have the one-third for operating expense, and again this is 4,000, and accumulated depreciation truck will be credited by 12,000. Let us go to part B now. And in part B, give any entry necessary to record depreciation on the truck for the first year that it was in service, assuming the 7 leases were on the same reservoir. The total, now you can see that here in the part 8 was different reservoir, so that's why we did not use the unit of production. But now for part B, they are assuming it is in the same reservoir, and we have this information. Now, so that means because it is in the same reservoir, so the truck is going to be used only in one cost center, and it would be depreciated using unit of production, and the amortization of wells and equipment including the truck will be 900,000 divided by 120, proved developed reserves of 120,000, and because this is at the end of the year, we are going to add the production of 30,000 barrels times 30,000 barrels, and this will be equal to $180,000. If we have to amortize only the truck, so the truck is for how much? It is for 60,000. 60,000, and once again 120,000 plus 30,000 barrels of production times 30,000 of production, and this is equal to 12,000. Now obviously theoretically the truck's depreciation should be allocated one-third to wells in progress, one-third to G&G expense, and one-third to operating expense as given in the question. However, in practice, Support equipment and facilities used solely on one cost center are normally amortized with other capitalized cost, and any related depreciation is not allocated between multiple activities. So the general entry in this case will be DD&A expense debit, and this is going to be debit by 180,000, and accumulated depreciation DD&A is credit by 180,000. Next, let us talk about cost disposition, non-working interest. Now, theoretically, the non-working interest should be amortized over proved reserves using the unit of production formula used to calculate the working interest in proved properties. But as the individual non-working interest may be insignificant in value, paragraph 30 of SFAS number 19, that is Statement of Financial Accounting Standards, states with regard to royalty interest, when an interest has a relatively large number of royalty interest whose acquisition costs are not individually significant, they may be aggregated. For the purpose of computing amortization without regard to commonality of geological structure features or stratigraphic conditions. If information is not available to estimate reserve quantities applicable to royalty interest owned, paragraph 50, a method other than the unit of production method may be used to amortize their acquisition cost. So, non-working interest may be amortized using a method other than unit of production, such as straight line method. If the non-working interests are not significant, the interest may be aggregated without regard to commonality. Now, non-working interest can be acquired in different ways. The dollar amount of non-working interest acquisition cost to be amortized depends upon the method of acquisition. Now, when minerals are purchased separately from the surface rights, the purchase price is the amount to be amortized. If purchased in fee, the cost of the property acquired in fee should be allocated between the surface and the mineral rights on a fair market value basis. The cost allocated to the mineral rights is the amount to be amortized. An overriding royalty interest is created out of a working interest by either retaining or carved out. An overriding interest is carved out when the working interest owner sells an overriding interest to another party, or when the working interest owner conveys an overriding interest to another party for some other reason, such as compensation for services rendered. An overriding interest is created by being retained when the working interest owner sells the working interest and retains an overriding interest, or when the working interest owner transfers the working interest to another party willing to develop the lease and retains an overriding interest. Let us solve an exercise on cost disposition non-working interest, and we will first solve an exercise on DD&A on overriding interest. Paul Jones, a landman, received a 1/10 overriding interest for his services in obtaining a lease for Lucky Company. The fair market value of Jones' services as a landman is 4,000. Total proved reserves related to the overriding interest at the end of the first year of production were 18,000 barrels. The overriding share of production during the year was 2,000 barrels. Prepare general entries of Paul Jones and compute DD&A for 2017-7. So first of all, there is an investment in overriding interest. So let us make the general entry. So investment in overriding interest is debit, and this is debit by 4,000, and revenue is credit by 4,000. Next, let us calculate the DD and A. So we have prepare production of 18,000 barrels plus 2,000 barrels of production, and the in cost to be capitalized is 4,000 times 2,000. So this will be equal to 400, and the journal entry will be DD and A expense overriding interest is debit by 400, and accumulated DD and A overriding interest is credit by 400. Let us solve one more exercise on overriding interest. Now Sharon Montes purchases a 1/8 overriding interest for 10,000. Proved reserves at year end 2006 are 20,000 barrels, and production for 2006 was 3,000 barrels. Prepare journal entries for Sharon and compute DD&A for 2006. Now, the investment again in this case is for $10,000. So, investment in overriding interest is debit by 10,000, and we are purchasing, so cash is credit by 10,000. You can see in the previous case they were receiving for the services, that's why revenue was credit, and here they are purchasing, so cash is credit. And now we calculate DD and A. Now that is going to be 3,000 divided by 20, and this is at the end of the year, so 20,000 plus 3,000 of production, and times the cost to be capitalized, and that is 10,000. So this is equal to 1,304, and the journal entry for DD and A expense will be DD and A expense overriding interest is debit by 1,304, and accumulated DD and A overriding interest is credit by 1,304. Next, let us solve an exercise on multiple non-working interest. Now, Lucky Oil Company has multiple small non-working interest located in Texas. The reserve information necessary to compute unit of production DD&A is not available. Further, the interests are individually insignificant, and the benefit received from computing DD&A for the interest on an individual basis does not justify the cost. The interest have been assigned a total cost of 60,000. Lucky amortizes such interest straight in line over 10 years. So the DD&A will be the cost, that is 60,000, divided by the number of years, so that is 6,000 per year. Now, another type of non-working interest is the production payment interest. A production payment interest generally has a shorter life than the total life of the reservoir. It is not always an economic interest for which amortization may be recognized. A production payment interest is an economic interest is one that is acquired by purchasing a portion of proved reserves. The cost paid for the proved reserves should be amortized as production takes place using total purchase reserves as the base. So let us solve an exercise on production payment interest. Paul Jones purchased a 10,000 barrel production payment interest for 150,000 from Lucky Company. The production payment interest is to be paid at the rate of 1/4 of the working interest share of production from lease B. Lease B has the burden of 1/6 of royalty interest. Total gross proved reserves are 40,000. Total gross production is 6,000 barrels. We have to calculate DD&A and we have to journalize as well. So the production for the year 2007 is 6,000 barrels. Now from this 1/6 is the royalty interest, so we are going to subtract 1/6 of the royalty interest, and 1/6 of 6,000 is 1,000 barrels. So we have 5,000 barrels, and this is the production for working interest and production payment interest. From this production to production payment interest is 1/4. So 1/4 is going to be 1,250 barrels. And the DD&A for production payment interest will be 1,250 divided by 10,000 times 150,000. That is equal to 18,750. Now you can see that in the DDA computation in this case, 10,000 barrels are used rather than these 40,000 of proved reserves, because 10,000 is the number of barrels purchased by Paul Jones. So the DDA is based on barrels received during the year relative to the total number to be received. And the journal entries, as they are asking over here, first of all, the investment in production payment interest is debit by 150,000. We are paying cash, so cash is credit by 150,000. And then the DDA and the journal entry for DDA and A expense, so DDA and A expense production payment interest is debit by 18,750, and accumulated depreciation DD&A production payment interest is credit by 18,750. Let us solve one more exercise on production payment interest. On January 1 to 2022, John Williams purchased an 8,000 barrel production payment interest from Watershed Oil Company for 800,000. The production payment will be paid out of 1/5 of the working interest, owner's share of production from lease number 1003. The lease is burdened with a 1/8 royalty interest. Gross production from lease number 1003 during 2022 was 24,000 barrels. Gross proved reserves were 130,000 barrels. Give the entries by John Williams to record the purchase of the production payment interest and DD&A expense for 2022. So first of all, we are going to compute the DD&A, and for this we have the production for 2022, and that is 24,000 barrels. Then the royalty interest over here is 1/8. So we are going to subtract 1/8 of the royalty interest, and 1/8 of 24 will be 3000 barrels. So we have the remaining 21,000, and this is the production for working interest and production payment. And you can see that 1/5 of the working interest is for the production payment. So the production to production payment, 1/5 of 21,000 will be 4,200 barrels. Okay. Next, we are going to calculate the DD&A for production payment. So this will be for production payment is 4,200 divided by 8,000 barrels that they have purchased times 800,000, and this is equal to 420,000. And the journal entries, as they say, first of all, there is an investment in production payment. So investment in production payment is debit, and this is debit by 800,000, and cash is credit by 800,000. Next, we have the DD&A expense, and DD&A expense production payment is debit by 420,000, and accumulated DD&A production payment is 420,000. Finally, let us talk about revision of DD&A rates. So reserve estimates that affect DD&A rates are at least reviewed annually, and such revisions to DD&A rates should be accounted for prospectively as a change in the estimates. That is, no change should be made to adjust accounts to what they would have been had the new estimates being used throughout the period. If the company reports on a yearly basis, then the revised reserve estimate is used in the year-end DD&A calculations. If DD&A is reported on a quarterly basis, then the effect of a change in an accounting estimate should be accounted for in the period in which the change is made. Now, there are two methods of recording it, and let us solve an illustration in this regard. Lucky Oil Company reports on a quarterly basis. On December 2, 2006, the company received a new reserve report dated November 30, 2006 concerning a fully developed lease in Texas. The reserve report showed proved developed reserves of 450,000 barrels. The last report dated 31st December showed reserves of 400,000 barrels. Net capitalized cost as of 31st December were 1 million. Production and amortization through the third quarter of 2006 are as follows. Okay, so we have reserve estimates now on November 30, 2006 is 450,000 barrels. Then we are going to this we are going to add the production for the first quarter, and that is 20,000, second 16, third is 22. So first quarter is 20,000, second quarter is 16,000, third quarter is 22,000, and then production for October and November is 10,000. So The reserve estimates for January 1, 2006 is 518,000 barrels. Now, the DD&A for the fourth quarter will be net capitalized cost of 1 million divided by the reserve estimates at the beginning of the year, that is 518,000, times total production of the fourth quarter, that is 23,000 barrels. This is equal to 44,402. So you can see that the fourth quarter computation of DD&A expense treats the fourth quarter as a discrete time period. So the DDA for the full year so amortization of the first three quarters, that is 50,000. First quarter is 50,000. Second quarter is 40,000. And third quarter is 55,000. And for the fourth quarter, we have just now calculated 44,402. So the total is 189,402. So you can see that the amortization for the year includes the first three quarters computation unchanged plus the fourth quarter amount computed using the new reserve estimate as it was reported on November 30. So in this illustration, DD&A rates are revised when a new reserve estimate is obtained, and this method shows the fourth quarter DD&A amount, the quarter in which the revised estimate was received, is determined by using the new reserve estimate converted to an estimate as of the beginning of the year. You can note that the DDA amount for the first three quarters, they remain unchanged, as would be the case with the change in estimate. Let us solve one more illustration on revisions of DD&A. Now, Lucky Oil Company reports on a quarterly basis. December 2, 2006, the company received a new reserve report dated November 30, 2006 concerning a fully developed lease in Texas. The reserve report showed proved developed reserves of 450,000 barrels. The last report dated December 31, 2005 showed a reserve of 400,000 barrels. Net capitalized cost as of December 31 were 1 million. Production and amortization through the third quarter of 2006 were as follows. So we have the reserve estimates on November 30, 2006, that is 450,000 barrels. To this we are going to add the production of the first quarter, that is 20,000, second quarter 16, and then we have 22. So first quarter, second quarter, third quarter, and then we have the production for October and November, that is October and November. So we have 20,000, 16,000, 22,000 and 10,000 barrels, and the total is 518,000 barrels. So the beginning of the year reserve estimate is 518,000 barrels, as we have calculated in the previous example. And let us see how we calculate the DD&A for full year. So for the full year, we have the cost to be capitalized as 1 million divided by 518,000 times total production for the year, that is 81,000 barrels. This is equal to 156,371. Now for the fourth quarter, first of all we have the amortization for the first 3 quarters, that is 50,000, 40,000 and 55,000. So the total is 145,000. And DD&A for the year we have already calculated, is 156,371, and we are going to subtract the 3 quarters less the DD&A for 3 quarters 1, 2 and 3, that is 145,000. So this is equal to 11,371. So you can see that the DD&A for the first 3 quarters is unchanged. The fourth quarter DD&A amount is determined by simply subtracting the total DD&A for the first 3 quarters from the DD&A for the whole year. Let us solve one more exercise on revision of DD&A. And Garfunkel Corporation has a working interest in lease A. Data for the lease as of 31st December 2018 is as follows. We have proved reserves and all the information is there, and we have to calculate DD&A for each quarter. That's why we have quarter 1, 2, 3, and then assuming the following production using both method described in the book. So we are going to use both the methods, and let us see how we are going to look into it. So the proof property DD&A for the first quarter is going to be 10,000 divided by proved developed reserves of 120,000 times net wells and equipment, that is 1,300,000, and this is equal to 108,333. Then I made a mistake. Actually, this for the proof property DD&A, this will be 10,000 for the quarter 1 divided by proved reserves, that is 180,000, times net proved property, that is 80,000. So this is equal to 108 4 4,444. Regarding the wells and equipment, we have 10,000 for the production divided by the proved developed reserves of 120,000 times the net well and equipment, that is 1,300,000, and this is equal to 108,333. For quarter 2, the proof property DD&A will be 12,000 divided by 180,000 times 80,000 and this is equal to 5333. Regarding well and equipment, we have 12,000 divided by 120,000 times 1,300,000. So this is equal to 130,000. Then for quarter 3, we have the production of 14,000 divided by 180,000 times 80,000. So that is 6,222. For wells and equipment, again we have 14,000 divided by 120,000 times 1,300,000. So that is equal to 151,667. Okay. Now comes the calculation for quarter 4, and the proved reserves as of the beginning of the year. Once again, we have proved reserves at the end of the year, and you can see proved reserves at the end of the year is 150,000. Now the production, you see, so the production in this case is going to be for when did they discover this. Okay, we are going to look back into the question here. November 30, 2006. You can see here that a new reserve estimate on October 31, 2019. That means we have to take the production up to the first 3 quarters plus October, because till this date we have the production. So 10 and plus 12, so this will be equal to 38,000. And the proved reserves now at the beginning of the year will be 188,000. Then we calculate the proved developed reserve at the beginning of the year, and again for this we have the proved developed reserve at the end of the year, that is 100,000, and we have the production again, that is 38,000, that is equal to 138,000. Now the proved property DD and A we are going to calculate by the 2 methods. So this is by the first method. So proof property, so for the last quarter, that is quarter number 4, will be 6 plus 4, that is 12,000, divided by proved developed reserves at the beginning of the proved reserves at the beginning of the year, that is 188,000, times net proof property, that is 80,000. So this is equal to 5,106. For again, for the first method, we have the wells and equipment DD and A. We have again the production of 12,000 divided by proved developed reserves on 1st of January, that is 138,000, times the net wells and equipment, that is 1,300,000, that is 113,043. Now let us see how we do it for the by the second method. So the total production for the year is 48,000, and the proof property DDNA. Now the total production is 48,000 divided by 188,000 times 80,000. So this is equal to 20,426. Now this is for the whole year, and from this we are going to subtract the DDNA up to October 31st. So we have 4,444, we have 5,333, and we have 6,222. So that is equal to 15,999, and this gives us the fourth quarter DDNA as 4,427. Regarding wells and equipment DDNA, we have 48,000 divided by 138,000. The proved developed reserves times 1,300,000, that is the net wells and equipment. So that is 452 174, and from this we are going to subtract again the DDNA for up to October January, February, March, October, yes, October 31, yes. March, April, May, June, July, August, September. So that will be 108,333 plus 130,000 plus 150,667. That is the three quarters. October, the three quarters. So this will be equal to 390,000, and when we subtract, this will be equal to 62,174. Okay, so this completes our discussion on exclusion of cost or on exclusion division of DDNA rates. And in this here we have talked about the exclusion of cost or reserves. We have talked about exclusion of cost of reserves. We have talked about depreciation of support equipment and facilities. We have talked about cost disposition of non-working interest. This include DDNA on overriding interest. We have talked about multiple non-working interest. We have talked about DDA and A on production payment interest and divisions of DD and A rates. So I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.